What happens when the smartest fund in the world becomes the most dangerous one? My name is Edmund Hale. I am not a trader, and I do not offer financial advice. I am simply a chronicler of markets, someone who observes the strange patterns that repeat themselves across generations of investors. In this chronicle, I want to tell the story of a fund that once appeared to represent the future of finance itself. A fund built by brilliant minds, guided by elegant theories, and trusted by people who believed that risk had finally been understood. For a brief moment in the late 1990s, long-term capital management did not look like just another hedge fund. It looked like a breakthrough. It looked like proof that the market, despite all its noise and volatility, could be measured, modeled, and mastered. To those watching from the outside, it seemed as though Wall Street had finally produced something rare, a machine built not on instinct, but on intelligence. That belief did not appear overnight. It was earned slowly, through consistency. The fund produced extraordinary returns. Its strategies appeared disciplined, controlled, almost clinical in their precision. The men behind it were not reckless speculators chasing headlines or momentum. They were traders, economists, and theorists whose reputations carried weight in the highest circles of finance. At the center of the story stood John Meriwether, a respected bond trader whose earlier success at Salomon Brothers had already made him a serious figure on Wall Street. Around him gathered a remarkable team, men whose ideas had helped shape modern financial theory, men whose work was taught in universities and discussed in the language of science. Two of them had even received the Nobel Prize in economics. To many observers, that fact alone seemed to settle the matter. If such people were involved, surely this was not ordinary speculation. Surely this was something more advanced. And in markets, that word has always had unusual power. Advanced, modern, scientific. Those words make people feel safe. Long-term capital management benefited from exactly that kind of language. It was not presented as a fund that guessed. It was presented as a fund that understood. Its strategies were based on relationships between prices, on patterns that had repeated again and again across markets and across time. According to the logic behind those trades, inefficiencies would appear, but they would not last forever. Prices that drifted apart would sooner or later return to balance. And when they did, the fund would profit. It sounded elegant. More than that, it sounded rational. There was no need for dramatic forecasts or emotional conviction. There was no need to predict the direction of the entire market. All that seemed necessary was patience, discipline, and the confidence to trust the mathematics. At first, the world rewarded that confidence. The returns were strong. Investors noticed. Banks noticed. Capital flowed toward the fund. And with every successful year, the reputation of long-term capital management grew stronger. What had once seemed impressive now began to feel inevitable. The fund was no longer merely respected. It was admired. And admiration in financial markets rarely remains modest for long. It turns into belief. The more successful the fund became, the easier it was for people to imagine that they were witnessing something exceptional. Not simply a profitable strategy, but a different kind of intelligence, a different way of seeing the market. It began to feel as though the uncertainty that had always defined finance was slowly being replaced by calculation. That is the moment financial history so often remembers. Not the collapse, not the panic, but the period just before it when confidence becomes so complete that doubt begins to disappear. Because once doubt disappears, something important often disappears with it. Caution. Long-term capital management did not look dangerous in those years. It looked stable, it looked disciplined, it looked, perhaps more than anything else, intelligent. And that is precisely what makes this story so important. Markets have always had a way of punishing recklessness. That lesson is easy to understand, but every so often they teach a different lesson, one that is far more unsettling. They punish certainty. And in the case of long-term capital management, certainty had reached a very unusual level. The fund did not merely believe that it had found opportunities in the market. It believed that those opportunities could be understood with extraordinary precision, that the world, for all its noise and complexity, would continue behaving within the boundaries their models expected. For a time it did, and that was enough to make the story dangerous. Because the most fragile structures in finance are often the ones that appear strongest just before they are tested. If long-term capital management had simply been another successful hedge fund, this story would not be worth telling. What made the fund so remarkable was the idea behind it. The strategy did not rely on predicting the future of the market. It did not require knowing whether stocks would rise or fall, or whether interest rates would move up or down. Instead, it focused on something far smaller and far more subtle. Small differences in price. In financial markets, similar assets rarely trade at exactly the same value. Two government bonds with nearly identical characteristics might differ slightly in price. Two financial instruments connected to the same interest rates might move apart for reasons that seem temporary. To most investors, those differences appear insignificant. To the models used by long-term capital management, they appeared measurable. The idea was simple. If two prices moved apart, they should eventually move back together. The fund would buy the asset that appeared slightly undervalued and sell the one that appeared slightly overvalued. When the relationship between the two returned to its normal balance, the position would generate a profit. This concept was known as convergence. At first glance, the strategy appeared almost elegant in its simplicity. The trades were not based on speculation about the direction of the entire market. They were based on relationships between prices that had repeated themselves many times in the past. If history continued to behave the way it always had, the trades would work. And for a long time they did. The opportunities appeared everywhere. Government bonds, corporate bonds, interest rate derivatives, and complex financial instruments all contained small inconsistencies that could be measured. Each individual trade produced only a modest gain, but the models suggested that the strategy could be repeated again and again across global markets. Small profits, repeated many times. That was the logic. But there was one important detail hidden beneath the elegance of the strategy. The price differences the fund traded were often extremely small. In order to turn those differences into meaningful profits, the fund needed to operate on a massive scale. Large positions were required, very large positions. To build trades of that size, long-term capital management relied heavily on borrowed money. Banks were willing to lend because the strategy appeared disciplined, and the people running it were among the most respected figures in finance. The mathematics suggested that the trades were safe. The early results appeared to confirm it. And so the positions began to grow. At first, the growth looked like success. But in financial markets, scale has a strange effect on risk. A strategy that appears stable at small size can become something very different when it grows large enough to influence the market itself. At long-term capital management, that transformation was already beginning. The models continued to function. The trades continued to produce profits. From the outside, everything appeared calm and controlled. But beneath the surface, something important was quietly changing. The fund was becoming larger than the assumptions that had created it. And that is where the real story begins. For several years, the strategy of long-term capital management appeared to work exactly as its designers had expected. The trades produced profits. The models continued to behave the way the mathematics suggested they should. And with every successful year, the confidence surrounding the fund grew stronger. On Wall Street, success rarely remains quiet for long. Investors began to notice the consistency of the returns. Banks noticed as well. Capital flowed toward the fund, and the reputation of long-term capital management slowly transformed from curiosity into admiration. The fund did not look like speculation. It looked like control. Large financial institutions were eager to work with them. Credit became easier to obtain. Relationships with major banks grew deeper, and the scale of the strategy began to expand beyond what most hedge funds could imagine. Positions that had once been measured in millions began to grow into billions. Government bonds across different countries, interest rate contracts, and complex financial instruments spread across global markets became part of the same system of trades. Each position followed the same logic. Prices might move apart temporarily, but eventually they would return to balance. And when they did, the fund would profit. At first, the larger scale appeared to make the strategy even more powerful. The profits increased. The confidence increased. Investors who had once watched cautiously now spoke about the fund with genuine admiration. On Wall Street, where bold claims are common and skepticism is healthy, long-term capital management had begun to earn something unusual. Respect. Part of that respect came from the people involved. John Meriwether had already proven himself as a formidable trader. Around him stood economists and theorists whose work had shaped modern financial thinking. The presence of Nobel Prize-winning economists added a kind of intellectual authority that few investment firms could claim. To many observers, the message seemed clear. If such minds were working together, the strategy must be sound. But success in financial markets has a subtle psychological effect. When a strategy works repeatedly, the human mind begins to transform probability into certainty. Trades that once required careful discipline begin to feel inevitable. Risk, which once demanded caution, begins to feel manageable. And slowly, almost without anyone noticing, confidence becomes belief. Inside long-term capital management, the model still guided decisions. When a position moved temporarily against the fund, the mathematics suggested patience. The relationships between prices had always returned to balance before. Why should this time be different? Most of the time, the market confirmed that logic. And each confirmation made the strategy appear stronger. But there was another change taking place, one that was far less visible than the profits reported to investors. The size of the positions continued to grow. Because the price differences the fund traded were small, the strategy required enormous scale to generate meaningful returns. To increase those returns even further, the fund relied increasingly on leverage. Borrowed money allowed the managers to build positions far larger than their own capital would normally permit. At its peak, long-term capital management controlled positions worth hundreds of billions of dollars across global markets. To the outside world, this scale looked like confidence. But in financial markets, scale does something unusual. It transforms small mistakes into large consequences. As the positions expanded and the leverage increased, the stability of the entire structure began to depend on one quiet assumption: that markets would continue behaving the way they always had. For a long time, that assumption appeared safe. But markets have never been particularly respectful of assumptions, even when they are supported by the most elegant mathematics. And somewhere beyond the offices of long-term capital management, events were already beginning to unfold that would test those assumptions in ways the models had never fully imagined. For several years, nothing seemed to challenge the logic behind long-term capital management. The strategy continued to function. The trades continued to close with profit. The models that guided the fund still appeared reliable, and the relationships between financial instruments behaved much as they always had. To investors watching from the outside, the story looked simple. A group of brilliant minds had found a way to extract small inefficiencies from global markets. They were not gambling on dramatic predictions or emotional convictions. They were simply identifying patterns that had repeated many times before, and repeating them again. But success in financial markets has always carried a quiet danger. The longer something works, the more natural it begins to feel. Risk becomes familiar. Uncertainty begins to fade. Trades that once required careful discipline start to appear obvious. What once demanded caution slowly becomes routine. Inside long-term capital management, the models continued to guide decisions exactly as they always had. When prices moved slightly away from their historical relationships, the fund would take positions expecting them to return to balance. And most of the time they did. But markets are not systems of pure mathematics. They are systems of behavior. Prices do not move only because of logic or historical patterns. They move because of fear, optimism, politics, and sudden events that arrive without warning. For a long time, those forces remained quiet. Then in 1998, something changed. The shift did not begin inside the offices of long-term capital management. It began thousands of miles away, in a place that few investors on Wall Street had considered a serious threat to global markets. Russia. The Russian government had been struggling under growing financial pressure. Economic instability, declining confidence, and political uncertainty had created a fragile situation that many international investors had underestimated. At first, the warning signs seemed distant, but financial systems are more connected than they appear. By the summer of 1998, concerns about Russia's ability to meet its debt obligations began spreading through global markets. Investors who had once been comfortable holding risky assets started reducing their exposure. Caution slowly turned into fear, and fear has a way of moving markets faster than mathematics can follow. When Russia finally defaulted on its debt, the reaction across financial markets was immediate. Capital began fleeing from risk. Investors sold positions that only weeks earlier had appeared stable. Liquidity began to disappear from markets that had once seemed deep and reliable. For long-term capital management, the consequences were far more serious than anyone had expected. The relationships between prices that their models depended on began behaving in unfamiliar ways. Assets that had historically moved together began drifting apart. Bonds that should have converged continued moving in opposite directions. The small differences in price that the strategy relied upon were no longer shrinking. They were growing. At first, the managers of the fund believed this was only temporary. Markets had experienced periods of disruption before. According to their models, extreme movements often created even greater opportunities for convergence. If prices had moved further away from balance, that simply meant the eventual correction could be even more profitable. So the fund did what its models suggested. It increased many of its positions. But markets, especially during moments of stress, do not always move toward balance. Sometimes they move further away from it. And in 1998, that is exactly what began to happen. The differences between prices continued widening. And for a fund built entirely on the assumption that those differences would eventually disappear, that change was more dangerous than anyone had imagined. At first, the managers of long-term capital management believed that the market was simply overreacting. Disruptions like this had happened before. Financial markets had experienced moments of panic many times in history, and each time prices had eventually returned to their natural relationships. According to the models guiding the fund, the widening differences between assets were unusual, but not impossible. In fact, from the perspective of the strategy, the situation appeared to create even greater opportunity. If prices had moved further away from balance, then the eventual return to equilibrium could produce even larger profits. Following the logic that had guided them for years, the fund increased many of its positions. To the managers inside long-term capital management, this was not recklessness. It was discipline. The models had worked before. The mathematics had been tested across years of historical data, and every previous disruption had eventually corrected itself. Why should this time be different? But something had changed in the markets. The Russian default had shaken global confidence in ways that few models could anticipate. Investors around the world were no longer acting according to historical patterns. They were acting according to fear. Banks began reducing risk. Traders began closing positions. Investors sold assets not because of valuation models, but because they no longer wanted exposure. And fear does not move in measured steps. It moves quickly. Instead of returning toward balance, the price differences continued widening. Assets that had historically behaved almost identically began drifting further apart. Financial instruments that had once moved together now reacted in completely different ways. Inside the fund, the losses began to grow. At first, the numbers appeared manageable, a temporary disruption, the managers believed. The model still suggested that convergence would eventually return. But the size of the positions changed everything. Because long-term capital management had built enormous trades across global markets, even relatively small movements in price now produced losses of extraordinary size. The leverage that had once magnified profits now magnified every unfavorable movement. Losses that might have been uncomfortable for an ordinary fund were becoming catastrophic. Each day the pressure increased. Banks that had once eagerly provided financing now began asking difficult questions. Some institutions demanded additional collateral to secure the loans that had allowed the fund to build such enormous positions. Others quietly began reducing their exposure. Inside long-term capital management, the situation was becoming increasingly dangerous. The model still insisted that the trade should eventually return to balance, but markets were no longer behaving according to historical relationships. Instead of converging, prices continued moving further apart, and every new movement deepened the losses. By late summer of 1998, the scale of the problem was becoming clear. Long-term capital management was no longer just another hedge fund struggling with a difficult market environment. The size of its positions had grown so large that its survival now mattered far beyond its own investors. The fund was deeply connected to the largest financial institutions in the world. If its positions were suddenly forced into liquidation, the impact could ripple across global markets. What had once appeared to be one of the most sophisticated investment funds on Wall Street was now something very different. It had become a systemic risk. And on Wall Street, the realization slowly began to spread that this was no longer simply a story about one fund making bad trades. If long-term capital management collapsed completely, the consequences might reach far beyond the walls of its offices. The smartest fund on Wall Street had suddenly become one of the most dangerous problems in the entire financial system. By early autumn of 1998, the situation surrounding long-term capital management had become impossible to ignore. Losses continued to accumulate, and the enormous size of the fund's positions created a new and far more dangerous problem. Long-term capital management could not simply close its trades and walk away. The positions were too large, too deeply connected to global markets. If the fund attempted to unwind everything at once, prices across financial markets could move violently. What had begun as a private investment strategy was now threatening to become a systemic event. The banks that had once competed to finance the fund now faced a difficult reality. Many of them were exposed to the same trades. Their balance sheets were tied, directly or indirectly, to the positions held by long-term capital management. If the fund collapsed suddenly, the losses would not remain inside one firm. They would spread. That realization changed everything. In September 1998, the Federal Reserve Bank of New York quietly intervened, not to rescue the fund itself, but to prevent the possibility of a wider financial crisis. Representatives from the largest financial institutions were called together behind closed doors. The goal was simple: stability. The solution that emerged was unusual. A group of major banks agreed to provide capital that would stabilize long-term capital management long enough for its enormous positions to be unwound gradually. The fund would not continue operating as it had before. Instead, it would slowly dismantle the trades that had once made it so powerful. The process happened quietly. There were no dramatic trading floor scenes, no crowds outside financial institutions, no sudden collapse visible to the public. But inside the financial system, one of the most sophisticated hedge funds ever created had effectively reached its end. Long-term capital management would survive only long enough to disappear. Looking back, the lesson of this story was never about intelligence. The people behind the fund were among the most brilliant participants in modern finance. Their models were elegant, their reasoning was logical, and for several years their strategy worked exactly as expected. But markets are not laboratories. They are shaped by events, by human behavior, by uncertainty, and by moments of fear that no model can fully anticipate. Patterns that appear stable for years can suddenly break when the world changes. The danger was never that the managers of long-term capital management lacked intelligence. The danger was that they believed intelligence alone could control the market. Financial history has repeated this lesson many times. Whenever investors begin to believe that risk has been completely understood, the market eventually reminds them that uncertainty has not disappeared. It has only been waiting for the moment when confidence becomes too strong. My name is Edmund Hale. I am not a trader, and I do not offer advice. I simply observe the strange patterns that repeat themselves across generations of investors. Thank you for listening to this chronicle.